Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. On May 8th, Nasdaq hosted a webinar on Reg NMS 2, the impact of redesigning equity market structure, focusing on the overall impact the SEC proposals on Reg NMS may have on current equity market structure. Our panelists included Cohen, Executive Vice President and Head of North American Market Services at Nasdaq, Justin Schack, Managing Partner and Director at Rosenblatt Securities, Boyan Petrovic, Executive Director and Head of Trading at JP Morgan Asset Management, and JJ Kinahan, Chief Market Strategist at TD Ameritrade. Cohen joins me for a recap with webinar highlights, and we were happy to see a robust audience of regulators, exchanges, academia, asset managers, banks, brokers, advisors, and investors participate in today's modern technology-driven marketplace. So, Tal, why does this topic generate a lot of interest from such a diverse group of market participants?
Hi, Jill. So what I think we heard is that the markets are functioning well. And based on all the progress we've made over the last 10 years in terms of resiliency and the new rules we've put in place and the safeguards and market guardrails we put in place, there was a question of whether now is the right time to engage on a broad and comprehensive proposal or take a more iterative approach. And I think that's what you heard throughout the conversation in the panel last week.
Do the panelists think that wholesale changes to the equity market is needed right now, given how it performed over the past 2 months with heightened volatility?
Yeah, I think it's a great question because we all discussed how the markets were functioning, and we all agreed that the markets functioned extremely well, in particular the equity markets versus some of the other markets, in particular fixed income. And so when we thought about the proposal that the SEC put forth in February, once again, there was an opportunity to take a step back, ask lots of questions, get input from the industry. There were over 300 questions in the proposal itself from the SEC. And so we just want to understand the consequences. We want to understand how it's going to impact all the good work we've done over the past 10 years to optimize and really refine the structure that we have in place today.
I got the sense the panelists were in agreement that if any changes are to be made, that it needs to be deliberate and gradual, not overarching. Would you agree?
I would, and I'd say we were lucky to have different perspectives. So the buy side, retail, broker, market structure experts, and exchange. And so what we all agreed to is we want to be disciplined and measured. And maybe most importantly, what we took away, and we did a poll on this, is not everybody's had an opportunity to digest this proposal. So the one request that we would make of the SEC is provide us with more time. There's a lot of questions. It touches almost all aspects of Reg NMS. So if we allow the industry to take a bit more time and digest the broad and comprehensive proposals they put out, I think they're going to get a better response back from the industry. And as Boyan put it, I think we are optimistic that we can make progress if allowed and given that opportunity.
The most spirited conversation was notably with the retail investor. It took place around the order protection rule and around that definition, ultimately leading into execution quality. What were some of the takeaways?
Yeah, we all gave credit to the SEC for trying to address the one-size-fits-all problem. I think all of us agreed on the panel that the SEC was spot on in doing that. We also recognize that odd lots have become a bigger matter in our market as a number of high-priced stocks lead to a lot more odd lot trading. Where I think we disagreed with the SEC proposal was around the complexity and the engineering of the solution they put forth. And so they introduced the concept of odd lots that are protected, odd lots that are not protected. There were round lots that are protected and round lots that may not be protected. So as we looked at what they've proposed, we said, yep, we have strong agreement that this is an issue, a root cause issue that we should take a look at. But it is the most complex part of the proposal. So we need to take a step back and understand if there are alternatives, other solutions that we might want to bring to bear that might be simpler and not have the same knock-on effects. And what you heard on the panel was it's possible for intelligent tick sizes, something that the industry came together on late last year, and we were part of that coalition and put a framework together. You also heard that we could also look at notional value, and that's in lieu of just stock price because that could remove some of the complexity. So we think there are other solutions, alternatives for the SEC and the industry to consider. It's the most complex part of it, and there isn't yet agreement on how we should handle it.
All right, and to wrap up here, going back to one size fits all, what was the consensus with single SIP, multiple SIPs, distributed SIPs, and competing consolidators?
And to put that into context, there were two proposals the SEC put forth. There was the January proposal, which they just put an approval order forward on last week, and then the February proposal. In the January proposal, it talked about consolidating plans and addressing governance. And for the most part, when it comes to consolidated plans, I think there's broad agreement on that. When it comes to governance, once again, I think there's broad conceptual agreement in terms of trying to improve the governance. There's a question about how we handle the new conflicts that might arise. And there's a question around the mechanics of the governance in terms of who gets votes, how many votes, and what responsibility and role each of the members will play. So there's still open questions on that. We're still digesting that. And then when you try to compare and contrast that to what we saw in February, where the SEC opened it up to the concept of competing SIPs and expanding the core definition of data that's in the SIP, it didn't fully align with what we saw in January. So I think there are questions about that. We think it could lead, in particular competitive SIPs, lead to an arms race. And we're worried about that in terms of the two-tier market and the optics that it might present. And there were questions and concerns around core data and how it impacts performance, what are people really using it for in terms of the SIP, and how we should think about that as we traverse data center to data center and provider to provider. So there's still lots of questions. I think there's more concerns with regards to the February proposal based on the matters that they raise. And once again, I'm not sure exactly how it aligns to the January proposal. So there's more work to be done there.
All right, Tal, thank you so much for joining me on Trade Talks.
Thank you, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.